Okay, so let's unpack this. If you manage to get your hands on the most advanced AI chip in the world right now.
Good luck with that, by the way.
Right, yeah. But let's say you do. You spend tens of thousands of dollars on a single piece of cutting-edge silicon. It is, on its own, practically useless.
Oh, completely.
Like, if you just plug it into a standard server rack and turn it on, it will literally melt.
Yeah, just melt right down into a puddle.
Exactly. And before it melts down into a puddle of, really expensive slag, it will probably trip the circuit breaker for your entire city block.
And that thermodynamic wall, that's exactly the hidden reality of the artificial intelligence boom right now. I mean, we spend all this time talking about the software.
Yeah, the algorithms, the parameters.
Exactly. But the physical reality of keeping these systems running, it's becoming the single biggest bottleneck in all of tech.
And today, you and I are looking at the company tasked with keeping the AI revolution from catching fire.
Literally catching fire.
Right. So, welcome to a special Talk Tickers deep dive. If you've joined us for these briefings before, you know the drill. We take a stack of dense corporate earnings transcripts, we strip out the fluff, and we translate the heavy Wall Street jargon into plain language.
And we try to keep it actionable.
Always actionable.
Yeah.
We're data forward, we're highly opinionated, and we're aiming to get you the most critical takeaways for your portfolio. Today, our crosshairs are locked on Flex Ltd. Specifically. We're breaking down their Q1 fiscal 2027 earnings call.
Yeah, and to truly wrap your head around what we are about to discuss today, you have to completely discard any outdated view you might have of Flex.
Because it's not the same company.
Not at all. I mean, if you've been in the market for a while, you might remember them as a traditional contract manufacturer.
Yeah.
The old mental model is, a company that takes someone else's blueprints, slaps together some plastic and low-margin silicon, and just ships it out in a cardboard box.
But that is ancient history.
Yeah, it really is.
That is not what is happening here at all. If the AI boom is the modern gold rush, everyone on Wall Street is obsessed with the miners, right?
Oh, yeah. The big tech giants.
The tech giants panning for gold, or even the semiconductor companies selling the picks and the shovels.
Yeah.
But Flex is operating a layer deeper.
They're building the mine.
Exactly. They are the ones physically constructing the entire mining operation. They're laying the high voltage electrical grid so the miners don't freeze in the dark. And they're building the massive water infrastructure so the drills don't overheat and shatter.
And that framing is so essential because when you look at the headline numbers from this Q1 2027 call, that transformation from, a passive builder to an indispensable engineering partner, it's just staring us right in the face.
The numbers are loud.
So loud. They tell a story of a company fundamentally altering its DNA.
Well, let's dive straight into that first pillar then.
Yeah.
Let's lay out the headline numbers, the actual what of the situation before we get into the why.
Sounds good.
So for their first quarter, revenue came in at $7.9 billion. That is a massive 21% year-over-year jump.
Which, for a company of this immense scale, a global manufacturing giant dealing in atoms, not just bytes, that is staggering.
Yeah, because it's physical.
Exactly. Growing software revenue by 21% is one thing, right? You just sell more licenses.
Copy and paste.
Right. But growing physical manufacturing revenue by 21%, that requires moving literal mountains of raw material, coordinating global supply chains, and executing on massive, deeply complex industrial contracts.
But the revenue isn't even the number that made me stop and reread the transcript. The bottom line is where this gets completely crazy.
We're the EPS.
Yes. Adjusted earnings per share, or EPS, hit a record $1 per share. That is a 39% year-over-year increase.
Pushing the margins up across the board, yeah.
Right.
We are looking at an adjusted gross profit totaling $761 million. That pushed their adjusted gross margins to 9.6%, which, let me check the notes here. Yeah, that's an improvement of 50 basis points from the prior year.
And adjusted operating profit hit $534 million, which is up 35% year over year.
Huge.
Bringing the adjusted operating margins to 6.7%, up 70 basis points.
And look, if you are outside the manufacturing world, hearing about a 50 basis point expansion, which is just half of 1%, right?
It sounds tiny.
It sounds like a rounding error. But in the realm of large-scale infrastructure and global manufacturing, 50 basis points on $7.9 billion in revenue. That is a seismic shift in profitability.
It's real money.
It's an incredibly difficult needle to move.
Wait, I have to stop us right here, though, and look at this disparity. Because this is the exact kind of thing you want to look for when you're analyzing a stock for your portfolio. A 39% jump in earnings per share on a 21% jump in revenue. I mean, that means the bottom line is growing almost twice as fast as the top line.
Right.
So if they aren't just selling 21% more stuff, they must be selling entirely different, significantly more expensive stuff. Or, and this is my pushback, are they just aggressively cutting costs?
That's the bear case usually.
Right. Are they firing people and trimming the fat to artificially inflate that EPS for the quarter just to please Wall Street?
It is the exact right question to ask, because a lot of companies will do that. They'll starve their R&D or slash their workforce to, manufacture a great EPS beat.
We see it all the time.
All the time. But based on the transcript, this is not a story of a company starving itself to look profitable. The management team, specifically the CFO, Kevin Crum, he made it clear this is a textbook margin expansion story driven by business mix.
Okay, so when they say business mix, they aren't talking about suddenly getting 10% more efficient at making cheap plastic widgets.
No.
They are actively phasing out the low-margin legacy stuff entirely and replacing it with high-margin infrastructure.
Exactly.
It's like a fast food joint realizing they can make infinitely more money selling Wagyu steaks to a captive audience, so they just stop making the dollar menu burgers.
That is the exact mechanism. They are actively choosing to lean heavily into high-value markets. And yeah, management did mention underlying productivity improvements, meaning their factory floors are getting smarter and more efficient, right?
Sure.
But the real driver is what those factories are churning out. They are proving they can scale efficiently while taking on highly complex proprietary work, particularly in the digital and electrical infrastructure space.
So they're moving up the value chain.
Big time.
And knowing exactly what is driving that business mix is, I think, the only way to understand where this stock is going. Because the executive team threw around a lot of heady Wall Street acronyms on this call.
Alphabet soup.
Yeah, CPI, ITS, RMS, BINCO. So if you're looking at your portfolio right now, you need to understand what these divisions physically make.
Right.
Because that is where the real story lies. So let's start with CPI. Cloud and power infrastructure.
Oh, this is the absolute crown jewel of the current AI narrative for Flex. The CPI segment generated $2.2 billion in this quarter alone. That represents a 35% year-over-year growth rate.
35% growth in heavy infrastructure. That's wild.
It is.
And this segment is growing so aggressively and is so strategically distinct from the rest of their legacy business that management announced they are actually going to spin it off into its own independent tax-free company.
Right. They are currently calling it SpinCo, which is just, the financial placeholder name until the new entity officially launches in the first quarter of calendar 2027.
Okay.
And Revathy, the CEO, she spent a lot of time on the call explaining why this maneuver is happening. She stated that SpinCo requires a completely different capital allocation framework than the rest of Flex.
We need to break down the financial mechanics of that for a second. Because if you own Flex or you're thinking of buying it, this spinoff is the catalyst.
The major catalyst, yeah.
Why does taking one company and splitting it in two suddenly unlock billions of dollars in shareholder value?
Well, it comes down to how Wall Street values different types of businesses. It's often called the conglomerate discount.
Right.
If you have a massive company where, say, 80% of the revenue comes from slow and steady industrial manufacturing and 20% comes from high-growth AI infrastructure, the market tends to look at the whole package and assign it the boring, slow-growth valuation multiple.
So they might price the stock at, 12 or 15 times earnings?
Exactly. Because the massive weight of the slow-growth stuff anchors the overall valuation down.
That makes perfect sense.
But the moment you spin off that hypergrowth 20% into its own separate stock, SpinCo Wall Street can look at it in isolation. Suddenly, mutual funds and tech investors who only want pure play AI exposure can buy it. And because it's growing at 35% or more, the market might value it at 30, 40, or even 50 times earnings.
Wow.
So by separating them, the combined value of the two new stocks is often dramatically higher than the single legacy stock.
And doing it tax-free means they aren't bleeding capital to the IRS just to reorganize their corporate structure.
Actually.
But what really fascinated me on the call was how Revathy justified the core mission of this new SpinCo. She explicitly warned investors that many people still think about AI purely as a compute story.
Yes.
Like they think it's just about who makes the fastest silicon.
She was very pointed about that. She said AI is rapidly shifting from a compute story to an infrastructure story, and more specifically, a power and cooling story.
Right, because the chips are getting so hot.
Exactly. The AI might live in the cloud, but the physical infrastructure required to keep that cloud from evaporating is intensely demanding.
Which brings us back to the melting chip from the intro.
Right.
If you buy a multi-million-dollar hypercar, like the pinnacle of automotive engineering, you can't just drive it to the corner gas station and fill it with regular unleaded.
No, it wouldn't work.
And you can't just park it in your standard suburban garage. You realize very quickly that to operate this machine, you need to build a custom high-octane fuel depot in your backyard. And you have to install a specialized liquid radiator system just to keep the engine block from cracking when you turn the key.
The hypercar is entirely useless without the bespoke infrastructure to support it. And as AI scales from, thousands of GPUs to hundreds of thousands of GPUs in single facilities, the constraint is no longer just getting your hands on the chips.
It's the environment around the chips.
Yes. It's the power delivery, the thermal management, the electrical architecture.
Revathy repeated a very specific phrase multiple times on the call in different ways. She said, Spinco is not a data center components company.
He was very clear on that.
Yeah, she wants to make sure nobody thinks they're just selling racks and generic server trays. It is a digital and electrical infrastructure company built to solve power, cooling, and scaling challenges.
And we really need to dive into the concrete engineering examples they discuss here, because this is where you stop seeing Flex as a generic manufacturer and start seeing their proprietary moat.
Let's do it.
Let's look at the cooling side first. The radiator for our melting hypercar. On the call, they highlighted their recent acquisition of a company called JetCool.
Okay, so why does JetCool matter? I mean, if you picture a data center in your head, you probably imagine long aisles of black server racks. And if you've ever been in one, you know it sounds like a jet engine and feels like a refrigerator.
Oh yeah, it's freezing.
Right, because massive HVAC units are just blasting freezing air down the aisles. So why can't they just keep doing that for AI?
Because of the laws of thermodynamics.
No.
Traditional CPUs might draw 100 or 200 watts of power. Air cooling can handle that just fine. But the newest generation of AI accelerators, these massive GPUs, they're drawing 700, 1,000, even 1,200 watts each.
Wow.
Yeah. So when you pack dozens of those into a single server rack, the heat density becomes so extreme that moving air physically cannot carry the thermal energy away fast enough.
It's just not dense enough.
Exactly. The specific heat capacity of air is simply too low. It is thermodynamically impossible to cool the next generation of AI with air conditioning. You must use liquid.
And that is exactly where JetCool comes in. They bring industry-leading cold plate capabilities to Flex.
And a cold plate is exactly what it sounds like. It is a highly engineered piece of metal that is mounted directly on top of the hot AI silicon.
Right.
But inside that metal plate are microscopic, labyrinth-like channels. A dielectric liquid, or specially treated water, flows continuously through those microchannels, absorbing the heat directly at the source, inches away from the processing cores.
But you can't just slap a wet metal plate on a computer and call it a day.
No, you definitely cannot.
The liquid has to come from somewhere, and it has to go somewhere once it's boiling hot.
Yeah.
And that is why they spent so much time on the call talking about CD as coolant distribution units.
Yes.
Flex isn't just manufacturing the little metal plate. They're designing the entire circulatory system of the data center.
And during the Q&A portion of the call, an analyst from Goldman Sachs, Mark Delaney, he zeroed right in on this. He asked specifically about their traction in cold plates and CDUs. He basically wanted to know if this was just a science project or a real business.
Right. Is this actually making money?
Yeah. And Revathy noted that they are actively in the process of qualifying these CDU products with their end customers to scale the business up.
Okay.
She was transparent that the cooling portfolio is still nascent compared to their power business, but it is a critical high-growth vector for them moving forward.
Because a CDU is essentially the mechanical heart of this liquid cooling system.
Exactly.
It pumps the cold liquid into the racks, collects the hot liquid coming off the cold plates, runs it through a heat exchanger to cool it back down, and cycles it back. It requires immense precision, leak-proof engineering, and deep integration with the server racks.
Right, you cannot have leaks.
No, water and million-dollar GPUs don't mix well. But by owning this technology, Flex gets to co-design the cooling systems directly with the hyperscalers, the Amazons, Microsofts, and Googles of the world. They aren't waiting for a purchase order. They're sitting at the engineering table saying, here is the exact fluid dynamic architecture required to keep your next $10 billion data center from catching fire.
And that fluid dynamic architecture is inextricably linked to the other side of the physical bottleneck, the power delivery.
Which brings us to the custom gas station and the hypercar analogy.
Yes. The earnings call went incredibly deep into the industry-wide transition from traditional data center power to 400-volt and 800-volt power systems.
Luke Tunk, an analyst from Baird, specifically pressed them on this. He wanted to know if there were any risks, delays, or hiccups in moving to these high-voltage systems.
Right.
And Revathy didn't hesitate. She was incredibly confident, stating flat out that Flex is the absolute leader in this transition on the embedded power side.
And if you are an investor trying to understand why this company has such a massive runway, you need to understand why this voltage shift changes the math of the entire industry. Like, why does a data center need to upgrade to 400 or 800 volts?
Okay, let's use a water pressure analogy because electricity acts a lot like water in a pipe.
Perfect.
If you have a massive AI server rack that suddenly demands tens of thousands of watts of power, so a huge volume of water, you have two choices. If you keep the voltage low, meaning the pressure in the pipe is low, the only way to move that much volume is to use an incredibly thick, massive pipe.
Right.
In electrical terms, low voltage means you have to push a massive amount of electrical current through the wires.
And high current is the enemy of efficiency. High current requires thick, incredibly heavy, expensive copper cables. We are talking about copper bus bars as thick as your arm running through these server racks.
Just massive blocks of copper.
And yeah. And not only is that copper incredibly expensive, but pushing that much current through a wire generates its own massive amount of heat due to electrical resistance. You end up wasting a huge percentage of your power just heating up the cables before the electricity even reaches the chip.
It's just a waste. But if you step the voltage up to 400 or 800 volts, if you crank the water pressure in the pipe up to a blistering level, you can deliver that exact same massive volume of total power, but with significantly less current.
Which means you can use thinner, lighter cables. You suffer drastically less heat loss from resistance. The entire power architecture becomes exponentially more efficient.
Right.
And as rack power densities cross 100 kilowatts per rack, moving to high voltage isn't just a cost-saving measure. It is an absolute physical mandate. You physically cannot fit enough copper into the rack to power it at low voltage.
And Flex is designing that high-pressure system. They are engineering and building these 400-volt and 800-volt architectures that will literally fuel the AI revolution.
Which is perfectly illustrated by a major partnership they highlighted on the call, which is the expansion of their work with Cerebris systems.
Oh, Cerebris is fascinating.
You really are.
They make the CS3, which is one of the world's most advanced, massive AI accelerator systems. It's essentially a silicon wafer the size of a dinner plate.
It's huge.
And Flex is the one scaling the manufacturing for it, right here in the United States.
And Joseph Cardozo from JP Morgan asked a highly revealing question about this during the Q&A. He asked if the Cerebris deal was just an advanced manufacturing contract, or if Flex was seeing pull-through demand, meaning are they also getting hired to do the power and cooling for these systems?
And the answer was that it is a completely holistic partnership. It is not just assembly, it's manufacturing, it's liquid cooling, and they're working on next generation power delivery architectures together.
Yeah.
It's a prime example of Flex diversifying its client base. They aren't just reliant on the 4 major cloud providers. They're becoming the engineering backbone for independent AI hardware innovators as well.
And this is where you really see the proprietary moat forming. Steve Barger from KeyBank pushed Revathy on exactly this point. He noted that other EMS companies, electronic manufacturing services, basically Flex's legacy competitors, they are also claiming to expand their AI capabilities.
Naturally.
Right. So he essentially asked, aren't your competitors just going to do the exact same thing?
And Revathy shut that down definitively. She pointed out that Flex's power business is fundamentally different because it is built on true intellectual property. True IP.
Exactly.
They aren't just taking someone else's 400-volt schematic and soldering the pieces together. They own the product design.
She told the analysts, I want to lead the technology conversation with our customers in terms of what does the future of power look like with your next generation silicon.
Wow.
I want you to really hear that phrasing. That is not the language of a passive contract manufacturer begging for a purchase order.
No, it's not.
That is the language of an indispensable engineering partner dictating the physical parameters of the future.
That's a great point. But as obsessed as the market is with AI, we have to look at the rest of the company too.
Oh, definitely.
Because when SpinCo separates in 2027, taking the cloud and power infrastructure with it, something has to be left behind. We have to talk about RemainCo.
Right, the mothership. Because while Flex is effectively birthing this AI infrastructure rocket ship, the remaining company is still an industrial titan generating massive cash flows.
Let's look at the IoTS segment Integrated Technology Solutions. This segment totaled $3.1 billion in revenue for the quarter. That is up 20% year over year.
And what drove that 20% growth is highly revealing. It wasn't consumer electronics. In fact, consumer-related markets were weak.
Which is pretty standard right out across the board.
Yeah, exactly. But that weakness was completely offset by explosive strength in advanced networking.
Tim Long from Barclays dug into this. He wanted to know how sustainable that strength in communications and networking really is, or if it was just a one-time blip.
And Michael Hartung, Flex's chief commercial officer, explained that this advanced networking boom is actually just another form of pull-through demand from the AI data center build-out.
Right, because AI doesn't just happen on one chip.
No. To train a large language model, you have to connect tens of thousands of these GPUs together so they can share data and talk to each other in fractions of a millisecond.
And that requires incredibly advanced networking hardware. We are talking about high-speed optical switches, massive routers, complex network interface cards.
Exactly. So even after Flex spins off the power and cooling business, the remaining company RemainCo is still going to be surfing a massive wave of AI infrastructure demand simply by building the physical networking gear that ties the thousands of GPUs together.
And we absolutely cannot forget the RMS segment, Regulated Manufacturing Solutions.
Right.
This segment brought in $2.7 billion in revenue, up 12% year over year.
And this is the bedrock of RemainCo. This growth was driven by strength in industrial markets, specifically warehouse automation, robotics, and energy infrastructure.
Stephen Fox from Fox Advisors asked a great strategic question here. He asked if this industrial strength was just a cyclical bounce back, like a temporary recovery from a slow period, or if it was secular.
Secular, meaning a long-term fundamental shift in the macroeconomic landscape that provides a permanent tailwind.
Exactly. And Michael Hartung confirmed it is highly secular, driven by massive macro trends.
Right, like regionalization.
Yes. First, regionalization. In the wake of global supply chain shocks, companies are desperately pulling their manufacturing out of concentrated overseas hubs and moving it closer to home shores.
They want it closer to the end consumer.
Exactly. And that requires building entirely new, highly automated factories across North America and Europe. Second, the global labor shortage in industrial sectors is forcing companies to invest heavily in robotics and warehouse automation just to maintain output.
And Flex builds those automation systems.
And the energy infrastructure piece of RMS is fascinating because it ties right back into the data center story. The utility scale infrastructure, the massive grid components needed to transmit power to these new data centers has to be modernized and built out. Flex is deeply embedded in manufacturing that physical grid infrastructure as well.
So when you look at the current quarter, the narrative is airtight. The product mix is incredibly strong, phasing out low-margin consumer goods for high-margin engineering. They are sitting exactly at the nexus of the physical AI bottleneck with their power and cooling IP, and the core industrial manufacturing businesses are surfing massive secular trends.
But the stock market is a forward-looking mechanism.
It doesn't care what you did yesterday.
No, it only cares what you will do tomorrow.
Yeah.
Which brings us to the forward outlook. What is management telling investors about the future? And I have to say, this is where the numbers go from impressive to truly staggering, particularly for that CPI segment.
Okay, let's lay out the exact guidance. For Q2 of fiscal 2027, they are guiding for total revenue between $7.95 billion and $8.25 billion. That represents a 19% increase at the midpoint.
And for the full year, fiscal 2027, they expect total revenue to land between $33.7 billion and $35.2 billion. That is a 23% increase at the midpoint.
Full year EPS is guided between 4.42 and 4.74, which represents a 39% increase at the midpoint. So that beautiful dynamic of the bottom line vastly outpacing the top line growth, that's projected to continue for the entire year.
But the absolute showstopper in this guidance, the number that likely had analysts rewriting their financial models during the call, is the CPI segment.
Yeah, this is wild.
Management is projecting CPI revenue to be up an incredible 65 to 75% for the full year.
65 to 75% growth in physical infrastructure. That is hyper-growth territory.
Right, you normally only see those kinds of growth rates in nimble software as a service startups that are scaling from a small base.
Exactly. Seeing a multi-billion-dollar heavy industrial segment project 70% growth is almost unheard of.
And there's a mathematical reality embedded in that guidance that we need to unpack. Because they only grew CPI by 35% in Q1.
Right.
And they guided for 45 to 55% growth for Q2. So if they are going to hit 70% for the full year, it mathematically means the growth is heavily back half loaded.
Yes.
The revenue generation is going to have to absolutely explode in the third and fourth quarters to drag the annual average up to 70%.
Which is exactly what Mark Delaney from Goldman Sachs picked up on immediately. He pressed management on this. He asked about their visibility into that massive second half acceleration, essentially asking, how can you be so incredibly confident that this massive wave of revenue is going to materialize 6 to 9 months from now?
And this is where we get into the concept of visibility. If you are a retail investor, you need to understand why visibility in this specific sector is so much more valuable than in standard consumer tech. CFO Kevin Crum stated they have over 90% visibility on booked business for the next 3 quarters.
Think about what that means. If you are a company that makes smartphones or televisions, you have to guess what consumer demand will be for the holidays.
It's a total guessing game.
You build millions of units of inventory, you put them on ships, and you pray that consumer tastes haven't shifted or that a recession hasn't crushed disposable income. If you guess wrong, you are stuck with warehouses full of unsold goods, massive write-downs, and missed revenue targets. Your visibility is low.
But in the hyperscale data center space, with 90% visibility, there is very little guessing.
None.
It means the contracts are already signed in ink. The hyperscalers have already committed the billions in capital. The demand is essentially locked in.
Right.
Flex isn't hoping they get orders in Q3 and Q4 to hit that 70% growth target. They already have the orders sitting in their backlog.
But having the orders on a piece of paper and actually fulfilling them in the physical world are 2 entirely different challenges.
Oh, absolutely.
And this is where the plot thickens. To achieve this 70% growth, to fulfill these locked-in orders, they admitted there are heavy, immediate facility and capacity investments required. Management guided for $1.5 billion to $1.6 billion in capital expenditure for the year.
They are literally pouring concrete, buying massive industrial machinery, and securing real estate today in order to meet the guaranteed demand coming tomorrow.
Which introduces the single biggest risk factor for the stock, execution risk.
Yeah.
Ruben Roy from Stifel asked the million-dollar question regarding this. He wanted a specific update on their installed capacity against this huge second-half ramp. Can they actually build the factories fast enough to build the AI infrastructure?
Or is there a risk they bite off more than they can chew, stumble on the rollout, and miss these massive deliveries?
It is the critical question, because if you fail to deliver on a critical piece of power infrastructure for a hyperscaler's $2 billion data center, you don't just miss a quarter's revenue, you jeopardize the entire relationship. But Revathy answered this with a level of confidence that speaks to Flex's core DNA. She pointed out that while the specific AI technology is new, the act of scaling massive manufacturing footprints is what Flex has done for decades.
Yeah.
They run large, deeply complex capital projects for a living. This isn't a software company trying to figure out how to build its very first physical warehouse. This is a legacy global manufacturing giant flexing its absolute core competency.
She gave concrete examples of how they are deploying this CapEx too. They are putting heavy manufacturing infrastructure in place right now. They are adding massive capacity in Dallas after acquiring a company called Crown, and they are adding capacity in Iowa after acquiring a company called EP2.
Yes.
They are physically expanding their North American footprint specifically to handle modular power deployment.
And modular power deployment is key here. Instead of building the power systems piece by piece inside the customer's data center, Flex builds these massive shipping container-sized power modules in their own factories in Dallas or Iowa, tests them thoroughly, and then ships the entire modular unit to the data center site to be plugged in.
It drastically speeds up deployment times for the hyperscalers.
Exactly.
And as an investor, you have to consider the alternative to this heavy CapEx spend. Yes, dropping $1.5 billion on concrete and machinery drops their expected free cash flow conversion rate from a historical 60% down to roughly 40% for this year.
Yeah.
But if they don't spend that money, they physically cannot fulfill the backlog, and they leave billions of dollars in guaranteed high-margin revenue on the table. Reinvesting cash into high-return, locked-in projects is the exact definition of a smart capital allocation strategy for a growth-oriented company.
It is the ultimate build it and they will come scenario, except the risk is removed because they already know the customers are coming.
Yeah, they have the receipts.
They have the receipts. The demand see-through is incredibly robust, not just for this fiscal year, but looking all the way ahead to fiscal 2028, where management had previously framed expectations of over 80% growth for the CPI segment. The pipeline is stuffed.
Okay, we have torn apart the headline numbers. We've decoded the product mix shift from legacy widgets to advanced liquid cooling and 800-volt power systems.
We covered a lot of ground.
We've analyzed the mechanics of the SpinCo separation, and we've walked through the massive 70% growth guidance and the CapEx required to execute it. Now it is time to come it all together. This is the moment in the deep dive where we synthesize all this data and take a definitive, opinionated stance.
Based on the raw data, the strategic maneuvering, and the macroeconomic tailwinds present in this transcript, what is the ultimate verdict?
Well, for a retail investor holding or considering opening a position in the stock ticker FLEX, this earnings call is a strongly, unambiguously bullish signal.
I agree completely.
The numbers are pristine, the visibility into future revenue is near absolute, and their strategic positioning at the exact physical bottleneck of the AI revolution is exactly where you want a company to be.
Yeah, and the actionable insight for your portfolio here is recognizing the valuation mismatch.
Tell me more about that.
Well, the market often misprices transitional companies for years. There are still institutional algorithms and retail investors valuing Flex based on its historical identity as a lower margin contract manufacturer.
Right, they see the old Flex.
They look at it as a slow industrial stock. But the reality on the ground is that they have entirely transitioned into a proprietary co-designer of integrated server power and cooling systems. The market is undervaluing their intellectual property.
They are the indispensable plumbing of the AI revolution. If you believe the core AI narrative is real, if you believe that Microsoft, Google, Meta, and Amazon are going to continue pouring hundreds of billions of dollars into new data centers over the next decade, which every piece of forward guidance suggests they are, then you have to acknowledge that every single one of those data centers physically has to be powered and cooled.
And Flex is the toll booth on that road.
And the SpinCo catalyst is the exact financial mechanism that will force the market to correct this valuation mismatch. By splitting the company into two, they are creating two distinct, easily understandable value propositions that cater to two completely different pools of capital on Wall Street.
Right. So let's break down exactly who buys what when the split happens in 2027. What is the pitch for RemainCo?
Well, RemainCo becomes the ultimate steady growth, highly diversified industrial play. It generates massive, reliable cash flow. It operates in high-value secular growth markets like warehouse automation, robotics, and advanced networking.
It serves as a bedrock global manufacturing platform.
Right. And this stock will appeal heavily to value investors, dividend funds, and institutional money looking for stability and cash generation with a solid macroeconomic tailwind of regionalization.
And on the other side of the split, you have SpinCo.
Yeah.
SpinCo becomes a pure-play, hyper-growth AI infrastructure stock. Because it is unburdened by the slower growth legacy industrial businesses, it can finally be valued at the much higher multiples typical of high-growth tech infrastructure companies.
It's going to look like a tech stock.
Exactly. It will have a capital structure designed specifically to raise money for rapid expansion and acquisitions. This stock will be a magnet for growth investors, tech-focused mutual funds, and retail investors who want direct, high-octane exposure to the physical build-out of artificial intelligence.
It's also worth noting a massive structural tailwind that management touched on. Flex was recently added to the S&P 500 index.
Oh, that is a huge deal.
Yeah. If you understand how passive investing works, you know this is a huge deal. When a company is added to the S&P 500, trillions of dollars in passive index funds are structurally forced to buy the stock, regardless of its daily price fluctuations, simply to mirror the index.
Right. It creates a floor.
It creates a massive permanent base of support for the share price. But beyond the mechanics of forced buying, it is a validation of their long-term strategic execution. It signals that Flex has officially arrived as a foundational pillar of the American corporate landscape.
So if we step back and connect this entire earnings call to the bigger picture, Flex has masterfully positioned itself to be the ultimate picks and shovels, or rather, the high-voltage grid and the liquid cooling towers of the most capital-intensive technological build-out in human history.
Which brings us to the wrap-up of our Talk Tickers deep dive. We always promise you data, plain language, and actionable insights. Let's do a quick recap of the core thesis.
Okay, so revenue is surging at 21%, proving their ability to execute at scale. Earnings are exploding at 39%, proving the business mix shift to high-margin infrastructure is working.
Yep.
AI power and cooling, the CPI segment, is the primary growth engine, growing at 35% now, and guided to hit a staggering 70% growth for the full year.
And management has 90% visibility into their upcoming revenue, meaning the risk of a sudden unexpected drop-off in demand is incredibly low.
Exactly.
They are spending heavily but smartly on CapEx to meet this locked-in demand. And the upcoming tax-free spin-off of the AI infrastructure business serves as a massive catalyst to unlock billions in hidden shareholder value by allowing Wall Street to properly value their hypergrowth segment.
Fundamentally, everything in this transcript points to a company executing flawlessly on a massive secular tailwind.
But as always, we never want you to walk away without something to chew on. We want to give you a question that goes beyond just what management spoon-fed the analysts and forces you to look at the horizon.
And here is that provocative thought for you to explore. During the call, CEO Revathy briefly mentioned that as AI scales, the ultimate physical constraint extends far beyond the data center walls.
Oh, this is fascinating.
It extends to the electrical grid itself. We aren't just talking about the power units inside the server rack anymore. We are talking about the physical utility grid outside the building, down the street, and across the state.
Right. So if you are tracking this stock or any stock in the AI infrastructure space, here is the million-dollar question you need to model out. At what point does the sheer physical limit of local utility grids, the literal inability of regional power companies to generate and transmit enough gigawatts of electricity to these massive new data center campuses, become a hard cap on Flex's hardware sales?
Yeah. I mean, if the regional power company literally says, we have no more juice to give you, does the hypergrowth suddenly slam into a brick wall?
And how will an engineering powerhouse like Flex innovate around a tapped-out global electrical grid?
Will they be forced to push further into manufacturing modular, self-contained microgrids?
Or, I don't know, will they start integrating small modular nuclear reactors into their power designs?
It's entirely possible.
That intersection of data center demand and utility grid exhaustion is the frontier you need to watch.
Because it's one thing to build the world's most advanced gas station for that hypercar. It's an entirely different problem if you wake up one day and realize the town's oil reservoir has completely run dry.
Exactly. The AI hypercar desperately needs a radiator and a custom high-voltage gas station, and right now, Flex firmly holds the blueprints and the manufacturing capacity to build them. Thank you for joining us for this special briefing. Stay curious, keep digging into the numbers, and we will catch you on the next Deep Dive.